Welcome back, everybody, to this week's episode of the JSS Podcast. I'm your local finance bro, Byron Enriquez, the casual executive. Today, we're going to dive into a little bit of the economics and the market, what's happening right now. I think there's a lot of buzz about interest rates all over again, and I keep getting questions asked by just people in my circle, or in social media, and just different things. It's kind of the question I think I get asked the most. What's happening with rates? What's happening with rates? And today I want to kind of just dive into that a little bit about what's happening with the market, what's happening with rates, but the psychology that comes with the marketplace and thinking about rates, and how, in my experience and history, has taught us that I think in times of higher interest rates and kind of uncertain markets, over the lifespan of this market, I feel, and I think it's been proven. I think the majority, the bigger portion of millionaires have been made in these markets, right? They're seeing an opportunity. They're approaching things differently, and so today I want to get into that little bit of that psychology, kind of what's happening in the market, how we should be focused, and what we should be looking at right now, as opposed to just focusing on the rate. So, I think a lot of the headlines right now is, oh my God, Fed chair changed. We were expecting him to immediately drastically start dropping rates, and he did not. And he pretty much said we're going to stay the course. Market is not anticipating a rate decrease, at least by the federal funds rate, for a couple quarters from now, right? So now what? Right. And first, I kind of want to dispel the myth a little bit that, at least in the mortgage market, goes hand in hand with the federal funds rate. And as much as you've been told or heard or think or believe, that's not the case. It is a factor, and it's something that we use to judge. But the federal funds rate is just a short-term interest rate that a lot of the banks can borrow from each other. And it's just kind of a placeholder, if you will, for banks are borrowing from each other, borrowing from the government. It's not the rate you're going to get. It's not the rate any consumer is going to get. Right. So that's not where the mortgage market usually stems from. Mortgage market is more treasury, is more based off of the treasury yields. We're looking at inflation numbers. We're looking at jobs numbers. We're looking at the economy as a whole when banks and lenders create interest rates, right? So it's a little bit of a different correlation. So it's not. I don't want people to focus in, hyperfixate on what's this guy going to say. As much as it should not be a political thing, we've seen over the last year and a half how interest rates and the federal government and the Federal Reserve has been weaponized, for lack of a better word, and it's been used in a political chess match where it's not supposed to be, right? It's supposed to be an independent body dictating rates based off of data, right? And I think it's been something that's challenged in the last year and a half, where you don't know what to believe. It's one side saying this data exists, someone saying no, sorry, we made it up. It's all over the place. So today, what I feel has just been my experience and my thought and my feelings is that regardless of what's happening in the market, regardless of what's happening, there is opportunities, and how we approach it is what's going to make the difference, right? I think every market creates a winner. You can win in anything, in every market. It's just how you approach it. It's, if you're using your brain to be able to see things differently and being able to challenge the way normal people are seeing it, or just how the normal everyday people, better said, are seeing it, and you're seeing these opportunities, slivers of opportunities, and this is where real millionaires are made. This is where people make a huge profits, because you're seeing something that the rest of the crowd isn't seeing, right? So that being said, there is that psychology of the crowd, right? So human behavior says, hey, when interest rates are low, let's jump in, let's buy, spend money, right? They're willing to overpay. They're willing to buy property sight unseen. They're willing to waive contingencies. They're willing to waive appraisals. They're willing to, they're they're driving these properties up to a value that, in my opinion, shouldn't be that value, right? But because interest rates are low and they feel they can afford more, they're pushing that, and they keep overbidding, and we've been seeing properties with 15, 30 offers. We've seen all over ask, and you're just like, that's, for those of us who've been in the business for a long time, we see that and it's like, that's not sustainable. That's how bubbles are made. That's how markets are set up to crash. And we have seen it in certain markets. We've seen Austin, we've seen Florida, we've seen Idaho, we've seen certain markets where there's been artificially created this increase in values that shouldn't be there, right? We're seeing, when we're looking at construction projects and we're trying to forecast a year, 2 years down the road when these properties will be finished and built, and then they're going to go up for sale. We're seeing, we do regression studies, and we're looking at, what do we feel, or what are we forecasting that market to be, and how much are these properties going to be able to sell for? A condo, single family, what is it that you're going to be looking at? And we've seen certain markets where, a year and a half ago, 2 years, when they started these projects to build, they were saying, oh, this property are going to sell for $1 million. Or let me take that back. In order to make a profit, these properties did sell for $1 million, which is a total different mentality, different set of data. Fast forward a year and a half, 2 years from now, I'm having a lot of these properties appraised, and appraisers are verbally telling me, they're like, there is nobody who lives in this market that can afford $1 million home, right? Yes, we've seen some outsiders. We've seen some people, outliers, that some of these properties have been purchased or bought or traded. But the average consumer in those markets does not make the kind of money to be able to afford those homes. So now you have properties where you have markets where your own product is becoming your own competition, right? That flooding the market with, 50, 100, 200 homes at one given point. And now you flooded the market. Now supply is overbearing, and you're seeing these properties sit. So now these same developers are having to chase their own tail and bring prices down, right? And some say, oh, well, that means the values are decreasing, the market's going down. It's not the case. It's a market correcting itself, right? Because there's certain areas where these forecasts were wrong. People were pushing numbers because they thought, hey, if we keep increasing, it's going to get there, and somebody's going to buy it, because rates are so low that people were willing to, again, overpay. And now we're seeing that that's not the case, right? So that's the kind of like the psychology of the crowd. There's people who jump in just when they're seeing these rates are so low, right? And rightfully so. You can afford more. It creates affordability. Your dollar stretches a little bit further in that market. But what it does is it's creating, again, like a false narrative to this market that doesn't exist. It's a false numbers that shouldn't be there, right? It's a lot of the conversations I've had with people, they're like, oh, when are we going to get to the 2.5, 2.75 rates again? I was like, hopefully never, right? And I know that may sound weird. A lot of people are like, oh my God, you're in the business, don't you want to see low rates? And I'm like, no, I want to see healthy rates. When rates were, that low, well, we were seeing what was called an inverted yield curve, where we were losing money. The marketplace is losing money on a lot of those yields that it was paying out. It just was not conducive to a healthy market. And someone asked me, well, you want rates to be higher? I can see it in the eyes of a consumer, and you're like, I want the lowest rate possible, and we all do, right? Myself included. On my own properties, I want the lowest rate possible. Looking at it on a macro level, looking at it as a market, looking at it as longevity in the marketplace, we need to have a little bit of higher interest rates. What it does is it controls the supply, it controls demand, it keeps prices increasing at a healthy rate, as opposed to seeing these spikes in values and appreciation in values that it's very inflated and shouldn't be there, right? So, in my opinion, I think we're seeing a big correction in that market where, we all knew a realtor, we all knew somebody that said that, the cheesy line, it's like, marry the house, date the rate, and wait for rates to come down, and then you'll be able to afford it, but right now you won't be able to afford it. So just, pinch your pennies and make it, and hang on. And now we're, 2.5 years into that and no relief in sight. All right. And that's what I had been telling people. I was like, we're not anticipating rate reductions for a long time. Market isn't there for it. We're still, when we have a change in administrations in the government, and they made a lot of promises that have not come true. We're still seeing inflation. We're seeing, groceries going higher. We're seeing taxes going higher for the average American. We're seeing price of gas through the roof with wars that nobody asked for. We're seeing a lot of these things where it's for the average everyday consumer, it's not helpful, right? And people were expecting to see, a lot of people were promised a lot of things, and it's obviously not coming to be, and then we're feeling that in the marketplace right now. But again, going back to my original point of we're getting to a place where it's creating a little more balance in the marketplace. We're creating a little more stability, in my opinion, where we're not seeing, these small little condos going for $1.5 million, where in no world, no conceivable economy, it should be. Right. And, if that was you and you got in and you were able to get out, and good for you, you made $1 million on a little one bedroom, one bath condo in the middle of nowhere, then good for you. But that's not a sustainable investment strategy. Right. But what's happening as rates go up, we're thinking about seeing there's going to be another rate increase or staying the same this week. I know when this video goes out, it might be a couple days later. But what happens is then that psychology of the behavior of the consumer goes into, oh, rates are high, I'm going to wait, right? So now we have a reduced competition going to the marketplace. We have less offers. We have the same properties that somebody would have overbid on a year ago because, when rates were half the price, now they're paying more. Now they're saying these properties are not worth it, even though the difference in that rate is only a couple $100 a month in payment, and it's a psychology about, oh, I have a 2% rate, I have 3%, I have 4%, I'm willing to pay more, right? But now they have a 6%, and they're like, no, pump the brakes. I'm not going to do that. So there's people who have exited the market and have said, hey, I'm not going to buy until rates come down. Those are the same people that have been waiting for the last 20 years, right? Because if it was linear in the fact that rates stayed here and values stayed here, rates went up, but the value stayed, and then rates came down and the value stayed. And if that was the case and those values stayed linear, yeah, that'd be a good thing. But you're seeing that increase in values, and there's a can't remember the term right now. There's a term in economics that once a price of a good or service has reached a certain number, regardless of the rest of the world, the economy and how that's doing, that price is not going to go down. The vendor, the supplier, the maker of that good or the seller of that good or service realized, hey, I can sell a gallon of milk for $15 and you're willing to pay for it. Why would I drop the price to $3? Right? They've created the new normal, which is what happens in real estate. It's you're creating these new normals of these prices, and it's just continues to step up and step up and step up, unless you see some catastrophic market crash, which again, don't see that happening, right? Famous last words, obviously, and could it happen? Of course. But unless there's some huge catastrophe or some big economic or political thing happening, we don't see a market crash like that, like we saw in 08 and 09. So if you're looking at the rates and the fluctuation of rates, but the pricing of real estate continue to appreciate, even if it's at a healthy rate or a spike, and your expectation of waiting for the rates to come down is never going to give you that number, because mathematically, by the time the rates come down, if the property is increased by 20% in value, then now you're still paying higher amount. Not only are you paying higher amount in for the total asset, but you're also paying higher amount in monthly interest. Right? So it's just the different mentality, how you approach things. Millionaires and some very, very successful people approach things differently. They think about things differently. They're looking at opportunities. They're not looking at the interest rate. They're looking at, hey, is it going to cash flow? Is it Is it is the value increasing? Is there an opportunity for me to add value to this and increase the valuation based off of this? What is there a problem in this market that we can solve for? Is there something happening? Is there transportation being built? Is there new housing coming in? Is there a new park, new schools, new shopping centers? What's happening in the area that's going to help my value increase, right? They're not focused on that interest rate, because interest rates are something we can't control, right? What are the rest of the factors that you can use to your advantage, right? We're seeing right now a lot of opportunities in the private market space, private lending, sorry, where speed, makes a big difference. So, in my case, the rates that we provide haven't changed, and they don't fluctuate because they're not so market driven. They're cost of funds driven, meaning I have a certain return that we promise to our investors for 18 months. So that doesn't change based off of the Fed. That doesn't change based off of inflation. Doesn't change off of Treasury notes. Yes, at some point we level set. Maybe every year and a half, we level set based off of what the market norm is, and we're creating competition for those dollars where they're going to invest in. So yes, we have to be attractive so that people can give us the money. But once they give us the money, that money's locked in at a certain rate of return. So it's not gauged by the market on an everyday basis, right? We're not SOFR plus, we're not Fed fund. We're not using the typical margins based off of we're not using the typical indices to determine our rates, right? So in the private space, our rates were, call it, 8, 9, maybe 10%, certain products. And yes, we were at that same rates when rates were at 2.5%, 3%. So now that delta between a consumer looking at our product and looking at a bank product, it was huge. And you're like, oh, wow, you're 6 points higher. But as rates have gone up, our rates have stayed pretty steady. So as you're seeing, your traditional conventional loans, 6.5%, 7%, and we're still at that 8.5%, 9% rate. Now that delta is shrunk dramatically, but yet our ease of use or ease of entry is so much easier when we can close a loan in a week, 10 days, and do some more flexibility than a lot of the other places couldn't. A lot of the banks, as rates go up, they're tightening up their lending, they're tightening up their guidelines because, they're losing money on a lot of these deals because they're also forecasting what capital markets is going to do and what they're going to sell those notes for and what they're going to make on interest. And there's a whole lot of other factors that that you don't see on the surface. So when we create that flexibility in the space, it doesn't seem that high anymore. It doesn't seem that extravagant. So, there's opportunities in these marketplaces, how do you use these tools to your advantage? History has shown us that those that were open to opportunities, those that were prepared, who had that vision, who were visionaries, those are the ones that have excelled, especially in these times, right? The times of uncertainty. When your average, homeowner, home buyer, investor is playing it easy. And I'm not saying take wild risks, right? That's not my style. I've never been that guy. You do take risks, right? That's no risk, no reward. So yes, it is in a time to take some risk, but it's a calculated risk where you're looking at not just the rate. And yes, of course, like I always say, don't buy a property thinking, oh, I can barely afford it now, but once the rates go down and I can refinance into it, then I'll be fine. That's not a good approach, right? Because if that never happens and you stay tight and you're not cash flowing, you're not approaching it the way you want to do it, then yeah, you can get yourself stuck and put yourself in a bad situation, right? We continuously, one of the things we track is foreclosures and notice of defaults and seeing how that market's changed, and it has increased. We are seeing that, and the reason for that is, unfortunately, there's a lot of consumers, and this is on the consumer side, and the consumers use their homes as a piggy bank, right? Use it as a savings account. So they're cash poor and they spend all their money on the house, and they're banking on the fact that equity in the house is going to increase. Once they get a little bit of equity, they pull it out, use that to supplement their expenses, travel, purchasing new toys, all the things, remodel their house, do the things that they want to spend their money on that they don't have enough of, and they're bleeding, they're sucking out that equity, right? And that's been going on for as long as I think home ownership has been out there. That's been happening. But when you see a market where the rates are getting higher, now that affordability is getting tighter and tighter and tighter. So even if there has been some increase in equity and they can potentially pull that equity out, but now that cost of making that monthly payment has gotten harder and harder to get, or they're not qualifying because some people barely qualified at 3% interest rate. And then when they're when the bank is looking at their debt to income ratios and they're looking at and how they're going to qualify at 6.5%, they don't qualify now. So now when they needed to pull that equity out to be able to survive, they're not being able to do so. All right. So it's one of the factors. And so we are seeing a uptick in foreclosures because of that. Right. And will we see more? I think it's too soon to tell. I mean, I think the last kind of information I was seeing that everybody is sitting on approximately 30 to 35% of equity into their property, something we haven't seen a lot of in the past. So there is still a lot of equity in property. So usually history had told us people don't walk away from equity. So before foreclosing on a property, they will put it up for sale so that they can at least cash out. So we will see, I think, some increase in that aspect of it, that some homes will be going on the market because instead of losing it, they have the opportunity to sell and still walk away with a little bit of a profit. So we are seeing a little bit of uptick in foreclosures, nothing huge, still pre-COVID numbers. Now nothing has spiked. But again, those are the things that savvy investors are looking at. They're looking at the market that they know, that they're expert in. One of the things that I've always taught you guys is, that market that you excel in. Is it residential? Is it commercial? Is it hospitality? Is it industrial? Is it land? What's that market? And know your facts about it. Know, hey, this is the zip codes I play in. This is the city that I invest in. I know what these homes do. I know what these prices do. I know when a school's coming in. I know when a park is being built. I know, what's being brought to our economy. I know what's being voted for on right now in housing and different things. And you're such an expert in that you know that regardless of the interest rates, you know what's happening, and you know how you can gauge appreciation, and you know how you can gauge rentability, and how you can be able to turn these properties and flip it or hold whatever your investment strategy is. And if you know that, then you're seeing these opportunities. You're looking at the data. You're looking at the foreclosure market. You're looking at days on market. You're looking at how many properties are flipping. Right. That's one of the things that I always like to see is, you can see when was the last time it sold. And if you're seeing the properties are turning over very quickly, those are usually people who are flipping properties. So usually the quality is a little bit less than it's than some, if you're building it for yourself, right? Not always, it depends on the market, but you're seeing these quick turnarounds, and you're seeing these sharp increases where the original homeowner or somebody who's owned it for a long time, it's a nice gradual increase in value, but now you're seeing these flippers who almost, are squeezing every last penny out of it by doing paint, appliances, all the things that they could do to squeeze that last little bit. And then if you're buying at that peak, there's not much you can pull from it. So if you're looking at the market and you look at those trends, and if there's a marketplace where properties are turning over quite a bit and there's, big step ups in value, that's obviously something to look at as well. So there's a lot of data, there's a lot of factors aside from interest rates to focus on, to make some very quality investment, make some investments. And I think this is the market. This is the time where I think people will do very, very well if you're prepared, if you've done your homework, if you talk to people, share and learn more right now, because right now these are the times. I'm seeing a lot of activity. I'm seeing a lot of creativity. We're seeing a lot of still the ultra luxury space. Certain markets are still thriving. People are building. There's if you're here in California, you're seeing these the headquarters of SpaceX, and you're seeing a lot of these tech. There's new millionaires popping up every day, and they're buying $10-15 million homes. So those are the things that I think create opportunities, regardless of interest rates. If you're seeing, those are the data that you should be looking at. What's happening? Where are the jobs in Arizona? I know that there's some, big chip factories that are being built. There's data centers, that are being built in certain places. And data centers, not necessarily bring in a lot of employment, because it's less employment than for that number of square feet. But that's something to look at. Aerospace is in certain places, defense. Obviously, with the tumultuous international stuff that we have going on, there's the defense sector is always big plus. So if you're in those markets where there's a lot of defense industries, then those are usually thriving and people are making money and bringing in more talent. So it's creating more demand. So anyway, that's it. And again, I can get super into the weeds with a lot of the interest rate talk and behaviors and the psychology of the consumer, but I just kind of wanted to level set a little bit of everybody, because I know that people get panicky and panic buy or get stressed out and they don't know what to do. Just want to share some information and hopefully it brings some light. Or if you want to have more in-depth conversation, reach out to us. Here we're always available. Love talking about this stuff. We love sharing. We love guiding you guys down that path to successful entrepreneurship, being a successful investor. So if you have any questions, hit us up. You know where to find us. Thank you.